market today says and tells you that investors are really looking at this as an optimistic move, that we're starting to see some opening here. The question, though, really lies in how is the consumer going to react? Are they going to want to go back to the restaurants or the hair salons and to take on some of these services that they haven't had access to in a while? And a lot of speculation is that we need a treatment or a vaccine to make consumers feel more comfortable with doing that. And then the second question is, these corporations or small businesses that have been working under a shelter-in-place order for going on 7 weeks now, are they going to be able to reopen in a manner that's going to benefit them from a profitability perspective? Have they gotten an SBA loan? We know that there's been trouble with that along the line. So as far as what Jeffrey Gundlach has said, I can understand his trepidation to what the movements that we have seen in the market. We don't know when the 26 million people that have already lost their jobs are going to be able to get back to work. We don't know if bigger corporations that have been operating under significant drop-off in demand and sales environment are going to have to eventually let people go because of that drop-off in demand and sales if it doesn't come back quick enough. So there's still, to me, a big lack of clarity with regards to how the economy reopens and how we get back on our feet.
There's also this problem that Gundlach brought up, which I've heard also anecdotally before, which is people making more money off the new expanded unemployment benefits as part of the CARES Act than they would have in their regular jobs, and just what that's going to cost in the long run in terms of employment and hiring. Moving on, though, despite growing talk of reopening the economy, companies continue to pull guidance this earnings season. We're basically seeing every single company doing that, pointing to the uncertain path toward recovery. Goldman Sachs out with a new note saying 3 suggested strategies they have for investors trying to navigate this unpredictable environment include avoid stocks with small business exposure, buy quality at a reasonable price, and buy goods-producing cyclicals. Goldman points to stocks like Regeneron, Facebook, Alphabet, Nvidia, and Lockheed Martin as fitting their criteria, Mike, which really just gets to the question of how to pick stocks right now in the absence of any real earnings, which is traditionally how you value these companies.
For sure. Implicitly, though, this call by Goldman is to say what has been working and not working will continue in that fashion for a while right now, because the market has already kind of clung to those areas where there's greater predictability, has abandoned bad balance sheets and exposure to in-person retail and things like that. So it's a little bit of a call to say more of the same. And I don't know if we really have enough information to know if we're going to be in this mode for a while, or if it's going to be a relatively brief period where we have this retrenchment and then quickly the market is going to shoot ahead and start giving everybody a mulligan for the next 2 quarters and look towards some kind of resurgence. I'm not saying it's easy to handicap one or the other, but you have to know that you're making a bet on the kind of environment we're going to be in if, in fact, you stick with the strong balance sheets and the more predictable businesses.